Hi, in this video I'm going to explain using examples how short farming works both on Mirror protocol and how it works in general because there are some differences. I'll also go through the basic concepts of farming and shorting to give some context. If you're unfamiliar with these terms, hopefully this video will have all the information needed to understand them. I will walk through the concepts in logical progression. Of course, nothing presented here is financial advice, and these strategies are inherently risky. Please do your own research and never invest what you aren't willing to lose. Alright, let's get started. Okay, so the first concept I want to talk about is long farming. And this is basically yield farming by providing liquidity. Usually this is what people typically talk about when they talk about liquidity farming or yield farming. What the long means is that the liquidity provider is betting that the underlying token, in this case is Luna, in the pool appreciates in value. And that's how they make money. How this works is that the liquidity provider deposits two tokens into a pool. In this case it's Luna and UST. And then as traders come and use the pool to swap tokens, so basically if they have UST, they want to come in and swap with Luna, they can do that. If they have Luna and they want to sell it to get UST, they can also do that. With every transaction a trader makes in this pool, they are charged a small fee. So that is what gets passed back to me as an incentive to provide liquidity into the pool. And so these trading fees and rewards are what make up the APR of that pool. So this process is basically what powers all decentralized exchanges in DeFi. So from a liquidity provider standpoint, how do they make money? Basically, they make money from the trading fees and incentives, which makes up the pool APR. And they also make money when the price of the underlying token, or in this case Luna, goes up. So then what are the risks, or what loses the liquidity provider money? The first thing is impermanent loss. The other risk is that the underlying asset that they are long on, the price of that goes down. So that, in a nutshell, is what long farming is. Before I get into the next concept of shorting, I want to talk about Mirror protocol. And what is the Mirror protocol? It is a Terra platform for buying and selling synthetic assets and what they're calling mAssets, like stocks. Basically, if I want to get exposure to a stock like Tesla or Twitter, but I don't have access to a brokerage, or I want to do it in a decentralized fashion, then I can use Mirror Protocol to speculate on the price movement of those stocks using their mAssets. I can also borrow mAssets using collateral on Mirror Protocol. So collateral is just something of value given to the lender, in this case Mirror, to hold in case I can't or don't repay the loan. And collateral, an example of collateral could be UST or a UST. Basically what will happen is I deposit UST onto Mirror, and then in return they give me shares of M Tesla or M Twitter so that I can either short it or do something else with it. And then finally I can also long farm, which we already went over, and short farm to earn yield on Mirror protocol. So later in the video I'll talk about how short farming works both on the Mirror protocol and in general. So I just wanted to quickly go over what the Mirror protocol is because the next section will use Mirror protocol as an example on how shorting works. Alright, so the next concept I'll talk about is shorting. And what that is betting that the price of an asset goes down and profiting due to that price movement. The steps in which this happens is, first is to borrow an asset, and on DeFi is usually with collateral. Then I sell it immediately to get back stablecoin or fiat. And then I wait and hopefully buy back the asset at a lower price to repay the loan. And then I pocket the difference. Let's go through an example of how this works on Mirror protocol. So in the first step, let's say I'm a speculator and I'm speculating that M Twitter will drop in price. So what I would do is use some collateral like UST and then deposit it on Mirror protocol in order to borrow M Twitter. And in this scenario, I'm borrowing, let's say, 5 shares of M Twitter. Then I will immediately go to TerraSwap and sell those 5 shares of M Twitter and pocket 100 UST. The next step is just to wait. And hopefully M Twitter will drop in price, and when it does, I will go back to TerraSwap, use my UST to buy back 5 shares of M Twitter. And let's just say in this scenario, those 5 shares are now 90 UST in price. So I bought it back for cheaper than I sold it at. That leaves me with 10 UST and 5 shares of M Twitter. The final step is to go back to Mirror and then repay the M Twitter that I borrowed. Then, once that happens, I close my short position and get back my UST, which was the collateral. So I started with 100 UST, and then I ended with 110 UST due to the bearish price movement of M Twitter. That's a 10% return on investment. So as a speculator that is short on an M asset, what makes me money? Obviously, if the price of the M asset goes down, that makes me money. And then also sometimes a platform will pay interest on the collateral. Mirror doesn't do this, but there are some platforms on DeFi that will pay a few percent on the UST that I've deposited. And what are the risks? What loses me money? If the price of the mAsset goes up, then I lose money because I have to buy back the shares at a higher price than I sold them at. There's also potential liquidation risk. So if mTwitter goes up in price sufficiently, then Mirror will use my UST to buy back the shares in order to pay itself back. And then finally, not specific to Mirror, there's also borrow interest. So sometimes the platform will charge me to borrow whatever token that I'm borrowing. And so that's how shorting works and how it happens step by step on the Mirror protocol. All right, I'm going to very quickly show how shorting can be done on Mirror protocol. Following the example, I'm going to short mTwitter. So I go to the borrow page and click on mTwitter, and then I'll use UST, let's just say 100 UST, to then borrow some mTwitter. And this collateral ratio is the ratio of the value of my UST to the value of the borrowed asset, in this case mTwitter. So at 200%, that means my UST is twice the value of the total amount of mTwitter that I'm borrowing. This 1.29 shares of Twitter is worth 50 UST. That's what this collateral ratio means. The higher this is, the less I am borrowing, and the safer my short position becomes. So I'm going to leave it at 200. And then click on borrow. And then I'll go to my page to look at my short position. So I can see that I'm borrowing mTwitter here. And then because I'm borrowing, I'm holding those shares. So what I'm going to do is immediately go to trade. And trading on Mirror protocol uses TerraSwap. So I'll go to mTwitter and immediately sell my shares of mTwitter. That'll net me about $55. If I go to my page, then I'll see that my short position has updated, and I now no longer hold mTwitter. I just have this borrowing position open, and it says that I owe this amount of shares of mTwitter, which is 50 UST. So I sold for 55 UST. Now I can just buy back this amount of mTwitter and pocket the difference. So I'll go back to the trade page, go back to mTwitter, and buy, let's say 55. And that will net me this amount of mTwitter, which is actually not enough. So I have to up it, let's just say 60. In this case, I lost money, but ideally what would happen is mTwitter will go down in price such that I can buy the 1.29 shares back at a lower price than 50 UST. Once again, I'll go to my page, and then now I have some shares again of mTwitter. So I'll just go to manage to close my position on the borrowing section, and I'll click on close. And because I have sufficient amount of mTwitter in my wallet, I can click close and it'll automatically withdraw my collateral of 100 UST and pay back the 1.29 shares that I have borrowed. And that's how shorting an mAsset on Mirror works. Now that long farming and shorting are covered, I can finally talk about short farming on the Mirror protocol. So what that is borrowing an mAsset on Mirror to enter a short position and then collecting trading fees and incentives from the liquidity pool that mAsset is a part of. Let's look at how this works with an example. So let's say I'm a short farmer and I want to bet that some mAsset is going to decrease in price. The first thing I will do is to use some collateral, in this case AUST, which is the Anchor token that I received back for depositing UST on the Anchor protocol in order to earn 20% or so APY. I deposit that as collateral onto the Mirror protocol to borrow some mAsset to short. Let's just use mTwitter for this example. Once I deposit my collateral and then enter a short position on mTwitter, what Mirror does is it immediately sells the mTwitter that I borrowed into the TerraSwap liquidity pool, and it gets back some UST for that sale. What happens when mTwitter is sold into the liquidity pool is that it increases the amount of mTwitter in that pool and decreases the amount of UST in that pool. And just as a side note, I think it's important to mention that this has the effect of bringing the mAsset price down since there's more of it in the liquidity pool. And what this does is it helps peg it to the Oracle price. And the Oracle price is just the real world price of the Twitter stock. So therefore, short farming is how Mirror incentivizes users to help maintain the mAsset peg. In return for me opening up this short position on Mirror, I get back what is called an SLP token, or a short token. This is what Mirror calls it. And what this short token does is it entitles me to some portion of the trading fees accrued by this liquidity pool. And as long as I hold this token, I can get paid in trading fees from this pool. And that's exactly what happens. At step 3, because I'm holding the short token, I receive back Mirror tokens as reward from this liquidity pool. Lastly, at step 4, after 2 weeks of opening my short position, the Mirror protocol gives back to me the UST that it received from selling the mAsset into the liquidity pool. The 2-week delay is there so that I don't immediately buy back the mTwitter and then mess up the pegging mechanism. So how do I make money? When I close my short farm position, what makes me money is collecting the trading fees and incentives in the form of Mirror tokens from this liquidity pool. And if the price of the mAsset, in this case mTwitter, goes down, then I also make money. And then finally, because I used AUST as my collateral, I'm earning interest on Anchor. What loses me money? What are the risks? If the price of mTwitter goes up, obviously I lose money. And then there's also the risk of liquidation. If mTwitter goes up sufficiently in price, then Mirror Protocol will sell my AUST to buy back the mTwitter in order to repay itself. So the difference between short farming and shorting is that I'm receiving trading fees and incentives from this liquidity pool. And short farming is how Mirror incentivizes users to help maintain mAsset pegs to their Oracle or real world prices. If you want to read more about how this process works, it's called short minting, and this is the address of the white paper for Mirror Protocol on GitHub. I'll leave a link for this in the description below. Let's put some numbers to the previous example to see how much a short farm investment can earn on Mirror. Imagine I have 1,000 UST to invest and that I've invested that UST into Anchor Protocol in order to earn the 19.5% APY rate. Because I've deposited on Anchor, I get back some AUST tokens, and at this conversion rate, I get back 809 AUST that I can use as collateral. Let's assume the short farm APR is 40% and the collateral ratio that I'm using for this position is 200%. At the current mTwitter price of $40, that means I am borrowing 12.5 shares of mTwitter, which is equivalent to $500. Let's say 30 days into the future, the mTwitter price has dropped to $25. I know that I've made money because in the short farm strategy, I'm betting that the mTwitter price is going to drop. The first source of profits is from the trading fees. This is the estimated fees paid out to me annually based on my initial investment, which is the $500 worth of mTwitter, and the short farm APR. So that results in $200 per year. Now, because I only participated in the farm for 30 days, that gets extrapolated down to $16.44. So that is what I made in trading fees from participating in the short farm. Now let's calculate the gain loss from the short. So I received $500 back 2 weeks after I opened the short position from selling the mTwitter at $40. And now I still owe Mirror 12.5 shares of mTwitter. At the $25 price point, I have to buy back 12.5 shares, and that's going to cost me $312.50. So after buying that back, I net a $187.50 gain from the short position. That's just the difference between these two numbers. Finally, the last source of profit is my Anchor gains. So in 30 days at 19.5% on my 1,000 UST, that nets me about $16. If I total all the sources of profit up, that totals about $220. And converting that to ROI, that's a 22% return on investment, which is pretty good for a 30-day investment term. Of course, I made some assumptions in this example. The short farm APR is constant. That's not true in reality. That's always fluctuating. And then I'm also not accounting for transaction fees, slippage, withdrawal fees. If I do account for these, then I will have less return on my investment. In this scenario, everything went right for me. But what happens if the future mTwitter price goes up and actually doesn't go down? So if I started my position with mTwitter at $40 per share and it goes up to $45, I'm still making return from the trading fees. And then I'm still making some return from the Anchor gains. But what's happening is I have to buy back the Twitter shares at a more expensive price point than I sold them for. And this gives me a net loss on my short. So because my Anchor gains and my trading fees did not offset this, then I have a negative return on investment. And those are two ways this strategy can make money and lose money. Now keep in mind, I didn't talk about any liquidation here, nor did I talk about what I could do with this $500 upon receiving it after the first 2 weeks. I could have deposited this into Anchor to make more yield, which I didn't account for in this calculation. So there's many ways that you can tweak this scenario to improve the return on investment for this short farm strategy. For the last part of this video, I'm going to talk about generalized short farming, which is short farming that is not specific to the Mirror protocol. On Mirror protocol, we're opening up a short position and then collecting trading fees from participating in the short farm. For generalized short farming, I still want to bet that the asset will drop in value, but I don't want to purely short the asset. So the steps to this strategy is first to borrow an asset with collateral, and then use that borrowed asset to provide liquidity to a long farm. And this is usually paired with a stablecoin. Then I will collect trading fees as APR return from the liquidity pool while I wait and monitor my position. And then when the token that I'm betting against drops in value, I can close the position and repay the loan. So for example, I want to bet that the cake token drops in price, and I can use Beefy Finance to short farm. So at step 1, I'm providing collateral to the Venus platform, which is a borrowing and lending platform on the Binance Smart Chain. And I can use Bitcoin, Binance Coin, USDC to provide as collateral. In return, I want to borrow some cake token. Then what I do with the cake token is I use it and pair it up with some USDC that I already have, and then provide liquidity to a Beefy Finance liquidity pool. So as I'm providing liquidity, I get trading fees back, and then I basically wait until I see the cake token drops in value, and then I can close my position and repay my cake to Venus. Now, this type of short farming is not specific to the Binance Smart Chain. There are a lot of DeFi platforms that allow borrowing and lending on different chains, as well as liquidity farming. And so any chain that has those two things with the token that I'm looking for, I can do this strategy. If I'm comparing generalized short farming versus short farming on Mirror, there are some similarities and there are some differences. For the similarities, for both strategies, I'm betting that an asset will drop in price, and both strategies involve borrowing an asset with collateral. The differences are, I'm just going to list the differences in terms of generalized short farming. For Mirror protocol, it's just going to be the opposite of this. So for generalized short farming, there's a risk of impermanent loss. I don't sell that asset immediately like I do in a short farm position on Mirror. It's a little bit less return on investment, but it's also less risky. And I'm probably going to be charged interest to borrow the asset. Whereas on Mirror, I'm not charged anything to borrow the asset. This is a Google Sheet that I use to make some calculations when I'm comparing 3 different strategies. First strategy is a long farm strategy. Then there's a pure short strategy. And then there is a generalized short farm strategy. I'm not going to go through the calculations in depth. I'm just going to present this here and then play around with the numbers to show how the returns compare to each other based on different price movements of the cake token. In the scenario where the cake price decreases from $7 to $5, the long farm is losing about 11%. For the pure short strategy, this is gaining 14%. And then finally, for the short farm strategy, this is gaining about 8.6%. So this is a little bit less return on investment than the pure short strategy because it's a little bit less risky. Now what happens if I increase the future cake price to, let's say, $9 from $7, which means it has increased in price. If I change that to $9, the long farm is up 18%. The pure short strategy is down about 14.6%. And the generalized short farm is down about 5.6%. So for rising prices in the cake token, the pure short strategy loses the most money. And then the short farm's losses are a little bit mitigated due to the farming and due to the increase in USDC that I get back. And then obviously the long farm performs the best. So I'll leave a link to this sheet in the description below if you want to play around with the numbers. And keep in mind that there's some assumptions. The liquidity pool APR is constant and I'm not accounting for any transaction fees, slippage, and withdrawal fees. Other than that, you can use this to compare all 3 strategies. In conclusion, I hope this video helped you understand a little bit more about short farming. I know there's a lot of terminology in the video, but if you didn't understand anything, go back and rewatch it again. I think it's important to explain the differences between generalized short farming and then how short farming is done on the Mirror protocol so that everybody can understand what the details are in these specific strategies. If you like the video, please hit the thumbs up and subscribe. Let me know what you think in the comments below. And as always, stay safe, and thanks for watching.